Good afternoon and welcome to the MJ Hudson Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and will publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Matthew Hudson, CEO, Peter Cornell, CFO, and Odie Lahav, COO. Good afternoon to you all.
Hello.
Afternoon.
So thanks for the quick intro. Yeah, I'm Matthew, the CEO. So this is a presentation in relation to our 6 months to December 21. So like all results, it's in the rear mirror. So in terms of, yeah, thank you. So in terms of what we do, I don't know who's on this call, but I better set the scene for those who don't know us. So we're a solutions provider to private markets. So we're essentially the picks and shovels play for private markets, and in addition, with increasingly with added data and analytical software-driven services as well. And we provide these services to the long-term private markets. We have over 1,400 clients who are very diversified. So when I say private markets, what I mean is private equity, venture capital, real estate, infrastructure, credit, renewables. This is essentially long-term private funds where typically the investors are pension plans, large institutions who invest in funds which last for 10 to 15 years. So it's a long-term asset class with long-term horizons. And what we do is, as you see from the slide here, is we work with both the fund managers but also the pension fund investors on their journey. And the journey is initially launched. So where they're launching a portfolio, where we're working with a pension plan, or launching a fund if we're working with a fund manager. So we help them we've got 3 divisions, but in the advisory division, we help launch funds. So launching it onto the private market. We then, in our outsourcing division, our second division, we help grow the funds, by which we mean we provide the mid and back office in the parlance, or the regulation, the accounting, the systems to help them operate their funds. And then we help, once they've started making investments, we help these funds report to their investors. And this is where our third division, which is data and analytics, comes in. We capture a lot of data in private markets. We then help analyze that data and analyze that performance, how they're done, the performance, the costs, the risk, increasingly the ESG in these funds. And then that cycle goes back to beginning again. But this journey is typically 10 to 15 years in most of our funds. It's a long-term journey. I started the business in 2010 on my own, and the very first fund I worked on is still operating now, 11 years later. But this particular fund manager has now launched 2 new funds as well. So it's a long-term journey. You work on one for 10, 15 years, then the next one's launched 2 or 3 years later, and you continue launching these funds. This slide here shows the divisions I mentioned, and how we break into these divisions. So the launching is the advisory. There's a law firm there. There's an investment consultancy there. The law firm typically work with the fund managers. The investment advisory work with big pension plans. So we announced we won a big contract with the UK local government pension plans to help them allocate up to 7 billion into private markets over the next few years. And that the advisory division is a bit more people-based. So you can see the target Ebitda margin at the bottom of 20% is the lowest margin in what we do. The outsourcing is heavily contracted, 100% contracted effectively, and fixed fees and very sticky in that respect, and has a higher margin target. Whereas the data analytics is more software driven, as I touched on earlier, and therefore should deliver a higher margin. Just in terms of where we are now, little under 12 years old. We listed on AIM on the day of the general election in 2019, which wasn't a deliberate ploy, but we couldn't seem to shake off Boris and his timetable. So we listed on the day of the general election in 2019, December 2019, then 2 weeks before a hard Brexit, 2 months before a global pandemic, and now we find ourselves in a war. I'm not saying we follow events, but we seem to a little bit. We look after 18 of the FTSE 100. These are either fund managers or their banks who are launching private market investment strategies, or their pension plans, as I touched on earlier, corporate pension plans investing in private markets. And these are some of our clients you can see here. So they range from very large groups. You can see some FTSE 100 there, to very small groups as well. I mean, our client base is diversified, as I mentioned, 1,400 plus clients. And we typically work with, what's very interesting about our model is we work typically with the smaller fund managers who need everything, the whole fund in a box. But we also work with the very biggest groups who need a particular tool or a solution or a jurisdiction for the very biggest clients. So I said already that we're in a 20-year plan, and we're a little over halfway through. So what do we want to be in 2030? Well, we want to be everyone, by which we mean a complete platform of services. We're about 75% built in that respect. We have a bit more to go, a few more jurisdictions to go, a few more products to go, but we're largely built. I mean, if we don't already own it, by the way, we own everything 100%. But if we don't already own it, we sort of use the best providers out there, and then hopefully that one day they may want to sell, and then they can sell to us. We've made a number of acquisitions during our time, so bolt-on acquisitions of teams and products we particularly already work with and like, who we think are best out there. And a bit like getting married, when they're ready to sell, they're ready to sell. If they're not ready to sell, they're not ready to sell. So we want to build out the platform, be over 2,000 specialists. When we say everywhere, it's not actually physically everywhere. We've got a number of offices. We're probably missing 4 jurisdictions around the world to be a global player in our market. But we certainly want to be in all the leading fund centres. So we're already in places like Luxembourg and Dublin and the UK and the Channel Islands, as well as where the fund managers in our space are largely congregated. Most of our client base at the moment is either UK or US, with some Northern European as well. We want to be at scale. So what I mean by at scale is, revenue over 200 million, but essentially we're still building, we're still growing. But after 2 or 3 years, we're focused on top line. 2 or 3 years, we'll start to more scale, which means synergies and maybe making acquisitions just to add scale and to increase the margins. But right now we're more focused on top line growth. So just a sort of quick overview of the 6 months to December 21. In our world, we may be a small company on the stock market, but in private markets, we're a very well-known brand. Be surprising to come across anybody in Europe in private markets who doesn't know who we are. US, we've got less penetration at the moment. So we've built a good brand. Point 2, the revenue and EBITDA for the 6 months to December 21 exceeds that for our whole year at the IPO. We basically doubled our revenue and more than doubled our EBITDA since the IPO. We've achieved significant growth, as you can see. We've also expanded our margins, point 4, with a sort of changed business mix. But what I mean by that is that when we IPO'd, we were over half our businesses in that first of those divisions, the advisory division, more people-centric, slightly lower margin. Whereas at the IPO, we said we raised capital to grow organically, but also grow through bolt-on acquisitions like the type I mentioned, buying from founders, experts. And that would mean our business mix would move more to the 100% contracted outsourcing and the over half fixed fee or subscription SaaS model, software-driven revenue and data and analytics. And you'll see later in this presentation, with more managed services, I call it that, rather than consultancy now by some distance. It's outsourcing and analytics is over 75% of our revenue now plus, and increasing. Point 5, yeah, we've added great clients. We represent some of the very biggest fund managers in our space in the world. Some big names. Point 6, yeah, we've rebalanced towards a high growth, high margin revenue mix, as already mentioned. We'll talk. Point 7, we'll talk in this presentation about the three current, our biggest growth opportunities right now. We talk a bit about as examples. I mean, we are growing in a number of places, but we're going to pick on 3, which are the biggest revenue growth we have right now for the 6 months to December 21. But also that's continued since that date. We're still growing nicely in the current half year we're in. Our year ends June. And as point 8, as I mentioned, we're only halfway through our 20-year plan. This gives you, I won't speak to this slide, you can see it. This gets to the point about the split now between our 3 divisions. The advisory, as I mentioned, is a bit more project based. It's a bit more time and materials, although frankly, it's quite fixed. It's very, you can see the revenue. And once you're the law firm of record on a fund, when you build a fund, you typically are for the next 15 years. So even though it's more consultancy based, advisory is actually very repeatable and you can see it. The outsourcing is the 100% contracted BIP based, sort of fixed based revenue, which a lot of investors like very much. And the data analytics is more software driven. But you can see the mix there. Odin, passing to you now.
Thank you, Matthew. So yeah, this slide we were just trying to show the organic growth in the company. So what we did is we stripped out M&A pre January 2021, and what you can see is the diversity of the business and the fact that the business, aside from investment advisory, aside from advisory, the business is growing quite well organically. And then you've got the growth as a result of the M&A, and within that growth in M&A, specifically, we also have the addition of the company that we acquired last year, which closed in February, called Bridge Consulting, which is our Irish Supermanco structure, which we'll talk about in a sec as well. So if we move on to the next slide, I don't know, Matthew, if you want to cover this, or would like me to do it. But I'll start talking about. Do you want to do it?
Yeah, let me cover it. So, right. In terms of the 3, by the way, I just make a confession. I passed to Odin too quick. I should have passed to Odin in 2 slides time. So he's a better talker than me. So in terms of the 3 sort of super growths we've had recently, I mentioned already ESG and sustainability. I don't think I need to tell anybody in this audience about this sort of super trend. But all of these 3 growth areas is driven by regulation. What drives our growth, apart from being very good at what we do, is more money being invested in private markets. And the private markets are, as I mentioned earlier, uncorrelated to public markets. They're long-term pension fund money going into long-term assets and companies. And the other big thing which moves our needle is regulated change. So ESG is driven by regulatory change. I won't bang on about it too much because you will know about it. But we bought what we consider the very best, small but very best ESG business in private markets in Holland, where they've been doing it for years, way before it was cool. And they've grown from 12. Now we're building it in Europe, UK, and US. We've grown from 12 to over 60 people. We've also built a leading digital platform, software platform, which Odie will talk about a bit later. And that's grown, that's grown very significantly over the 6 months of December 21 and continues to do so now. So that was an acquisition which we then built heavily on top of. The second one, Luxembourg, is a total build from scratch. So Brexit referendum in 2016. we saw a hard Brexit coming up, or a hard Brexit in financial services coming up. So we needed to be in Luxembourg, where a lot of funds are now moving to out of the UK, rather sadly. So as soon as the Brexit referendum happened, the price of these things went up. To buy one went up dramatically. So we built one from scratch instead. We thought it better return on capital. We spent about £5 million building this thing from scratch. Now it's profitable. And it grew by 45% top line growth to 6 months to December 21. So that's another rocket ship. And the third one, Irish Super Manco, is a very weird expression, but super means that it does private funds and it also does UCITS. And Manco means the mid office, the kind of regulation and substance, and now allow fund managers to distribute funds, to sell funds. You need to be regulated. If you want to do it properly. So Ireland's a big centre for this. So we bought a business called Bridge a couple of years ago, well, about 1.5 years ago. And they really wanted to, again, it's another example of founder-owned business, like everything else we buy. And they saw this scale up. They saw the regulations changing, and they thought they needed to be part of a bigger group because of that. And we've grown the regulated piece, the Manco piece in our term. We've grown from a little over €6 billion assets under management to contracted now over 70 billion, which is a hell of an increase. It's led to 67% revenue growth. We're 12 months ahead of schedule. The only downside, by the way, is that we've had to sink 10 million euros of regulatory capital into a bank account. It just sits there. We own it, the cash, but it sits there. Although it's now capped at 10 million in Ireland, but that's one of the drivers for the sale from the sellers. So these are three, and that's grown by 67% organically. So we sit on a number of sort of very high growth businesses on our platform, which we continue to invest heavily into. Now it's Odie's time.
Thank you, Matthew. Right, so I'll cover the operational review for the last 6 months. And you know, if you've been following the company, you may have heard some of this before. But the advisory division. So again, I'll go through each one of the 3 divisions. The advisory division is the one which had less positive performance than the other 2. This is a result of 2 things. So we've got a law firm in here, and then we have the investment advisory, as Matthew talked about before. As a result of lockdowns and a little bit as a result of the reorganization of the law firm, we had lower revenues alongside lower costs, luckily because of the reorganization as well. So we've been able to maintain profit, but at the same time, the overall revenues come down. And this is because of COVID, the overhang of COVID, and particularly the lockdowns, which slowed the expansion, I suppose, of the number of funds being launched into the market. And then the reorganization, which is temporary. And we saw at the end of every lockdown, as things were thawing out, we saw more activity, both in terms of M&A and in terms of new fund launches. But then again, with the next lockdown, things tended to slow down again, and then it popped back up. So we've seen corrections to that. But all the way up until the end of December of last year, things were a little bit slower. And since then, in the current trading period, so after the period that we're covering now, we have seen that trend in a more sustained way recover. So things are coming back to normal. And in fact, the market is pretty hot in a lot of cases as it comes to fund launches. The reorganization, we shut down Guernsey Law, which would have been in the previous year's numbers, but not in the current period. And that means that business was actually loss making. So again, helped our margins, but reduced revenues overall. Suffice to say, the law firm activity has picked up since the end of the year, and we do think that's going to continue going forward. And we haven't seen much, if any, slowdown at all as a result of the current geopolitical risk and the war in the Ukraine. Investment advisory also quite idiosyncratic. The reason revenues went down in this business is because we had management team in a client change, and it changed the nature of one of our engagements. We managed to maintain the engagement, even though there was a wholesale change with the client. But nonetheless, we've had to write down some of the revenues that we were expecting to get because of the change of engagement and the nature of it. But again, very, very positive in this current period post the end of the year, the end of the calendar year, and that's the result of the client win, which is Access Pension Pool, which is a huge win for MJ Hudson, 7-year contract, multi-million pound in nature. So if I move on to the next slide. So this is the outsourcing division. So this is middle and back office services. It's kind of asset management infrastructure that we sell. As Matthew commented, this has 2 of our 3 growth trends in here. So our Irish Manco and our Luxembourg business. You can see from the revenue numbers, 126% growth, organic growth of 21%. Overall, a lot of the growth that's in the inorganic part has been since the acquisition that was made, and that fantastic growth of AUM that Matthew talked about. So both extremely strong. And as you can see at the end of December, so only 4 months ago, the AUM was around 50 billion. Now Matthew talked about 70 billion. So seeing an absolutely fantastic spurt of growth here in that business. And in that, we've also invested in staff and systems to manage to scale. Aside from that, we also made an acquisition in the period, which is the Safri Chambliss fund accounting business, basically fund administration business. And that was around increasing scale and operating leverage in our business in Guernsey, which is both staff and systems, as well as diversifying the client base. Data and analytics, again, this had the other thematic growth that we saw in ESG. It probably goes without saying, but it is an area we're extremely excited about. I mean, ESG on its own grew 50% in the period after growing 100% in the previous financial year. Margins remain good, although we are investing heavily. We've scaled the team up even further than we had before. When we acquired the business just under 3 years ago, we had 12 people. We're now north of 60 people and still growing quite strongly. We have offices in the Netherlands, which has over 40 people in it now. We have London as well, which is a substantial team. In the next month or 2, we'll have New York, the New York team starting, where a few of the folk from Amsterdam are moving across to start that out. It's an area, so within data and analytics, a lot of the businesses are growing. ESG in particular is growing extremely well. Very, very excited about the system as well, which we launched in October. So just at the end of the period, and already it's generating 6 figures of revenue, and looking forward to getting to 7 figures very soon. This is on an annual run rate basis. We have within the business also performance analytics and our custodian bank benchmarking business, which service very large institutions, and they continue to win very large blue chip clients, which is very and the growth is in line with our expectations. And our quantitative solutions team, which is sales and risk management platform, has benefited quite substantially from our investment in cross-selling into that business. So a lot of good growth has come from sales which resulted from joining MJ Hudson. This was a business that we acquired at the end of June of last year. So it only had 1 period inside MJ Hudson, already growing strongly. But not only that, it's integrating really well into our platform and becoming a really important part of our technology platform and our offering. Aside from that, just flagging on the right-hand side, we did launch a joint venture with a lady called Sarah Smart, a business called Fides IQ, which leveraged the existing platform and our existing technologies to bring to life a business idea that Sarah had around helping pension funds improve their governance, basically, and particularly investment decision making in a systematic way. A couple more slides from me. So progress. This is just a little progress on our recent acquisitions. We talked a little bit about performance analytics. That's the Parax business that we acquired. Revenues tracking, as I said, client base is still fantastic and really accomplishing what we'd hoped it would, attracting very large, very blue chip names in the private market space. And on the right-hand column for these acquisitions, we tried to highlight how it is that we believe the group is adding value and what we've been doing investing in this business. So in the case of the Perax, it's been much more of a marketing focus. So it's marketing and campaign led in order to try to help increase sales. Also leveraging the group's relationship and cross-selling. And again, we've managed to win some very large clients as a result of group relationships. And also helped to get a few clients over the line that had already been in the works pre-acquisition, but helped get those done. So again, the benefits of being part of the larger group. Aside from that, we've started a software redesign and we've expanded the team as well. So all of which are lending themselves well to a successful integration of this business. Bridge, I've talked about quite a bit already. This is the Irish Manco business. Again, this has been sales campaign. It's about expanding the team. And we've started looking at systems and process improvements, but none of those would be in the numbers that we've announced so far. Claris Risk, this is quantitative solutions. Again, talked about it already, and the expansion of our team, as well as the introduction of group clients. So again, this is part of our M&A playbook and how we integrate companies and how we try to help those companies grow while being inside MJ Hudson. And integrating them into a service platform, which is what we're doing in data analytics in particular, but also in the AFM and Manco structures. Lastly, Safri Champness. This is the most recent edition. It's a bit too early to talk much about status or, in fact, what we've done. But suffice to say, we are investing in it. This is again systems as well as sales and marketing, at least the planning phase, and the business is integrating nicely. And with that, I will hand over to Peter.
Thank you, Odie. Just a few slides from me just to take you through the results, and I'll hand back to Odie and Matthew for our conclusions before the Q&A session. So from the interims, you will have seen these highlighted in the RNS. Underlying revenue up 50% to 17 million, of which 7% was organic. That masks the pattern that we talked about, that Odie talked about just now. So there was a reduction in advisory, but substantial increase, 20% plus in outsourcing and 30% plus in data analytics in the 6 months. Adjusted Ebitda increased by 89% to 3.4 million. A bit more on that in the next slide in a moment. The adjusted margins improved to 20% from 16%, which is reflecting the direction of travel from advisory towards the higher margin businesses, including the data analytics division. Adjusted profit before tax increased to 1.6 million from 0.4 and the EPS to 0.9 from 0.2. We will be announcing a progressive dividend at the end of our financial year, which Matthew indicated is June. And net debt increased by 13 million from 1.6 net cash at the end of 21, which I'll cover in a bit more detail when we look at the cash flow and balance sheet in a moment. So on the next slide, just comparing the 6 months with the previous years. So you can see on the left-hand side there, we're looking at revenue. And the underlying revenue has increased from 9.8 to 11 to 17 in this 6 months. Within our business, obviously we're showing growth quarter on quarter, but in each year, the second half is substantially bigger than the first. And we certainly are seeing that pattern repeat in this year as well, with what we've seen so far in the calendar year 2022. So we fully expect that pattern to increase. On the right hand side, the Ebitda at 3.4 million there compared to a flat 1.8 in the previous 2 years. On a last 12 months basis, December, the adjusted Ebitda was 7.2 million. And on the next slide, we'll show you the trend within the rolling last 12 months numbers. This is all looking back, so it's just before our IPO in 2019 that the rolling 12 months Ebitda numbers. You can see there's a plateau through the early part of COVID lockdowns. Then we commented in our full year results for FY21 that we'd seen this fairly significant acceleration in that 6 months. And you can see that's more or less carried on in a straight line up to 7.2 million for December. And as we've guided, we fully expect to be at the upper end of guidance that's in the market at the moment for his full year results. So in terms of profit and loss account, I've covered most of the items on here. Just one thing to flag there, which I'll talk more about in a moment. You'll see that our depreciation and amortization costs are increasing there, which is a direct reflection of the amount of investment that's happening in the business. And I'll talk to that more on the next slide, please, Odie. So in terms of our cash flow, the statutory unadjusted cash from operations, you see that's still small negative in the 6 months, but we're now cash flow positive in the current 6 months there. The line beneath that, the net cash used in investing activities, you'll see we invested £5.3 million in there, which is partly M&A activity, but within there, there's also £2 million just under of investment into fixed assets, whether tangible or intangible. On the tangible side, in this 6 months, there were 2 office moves, one in Amsterdam, obviously to accommodate the growth, and one in Guernsey, which is just under £500,000 of costs on those. There's over £1 million of investment into technology and software and products and process improvement in work within our technology team within the company in the year, and that's a significant area of investment that we expect to continue at least for the foreseeable future. Talking about the net debt I mentioned earlier, August 2021, you see we borrowed a further £7 million from Santander under the terms of our 5-year loan facility. That was entirely to meet the accelerated regulatory capital need of the Irish business. So we borrowed it from Santander on the one hand and then put it into a bank account where it's still sitting on the other within there. But that was significantly ahead of where they expected to be at the time we acquired them. But they couldn't have taken advantage of the growth opportunity without that regulatory capital injection. The only other thing I mentioned on here, the lease liabilities have increased, as I mentioned just now, due to the new premises there, and our Irish business will be moving office probably at the beginning of the next financial year. So more to come on that in the future. But then I think everything then should be pretty well established in terms of our physical infrastructure across the group. And that's all from me. So I'll hand back to Odie for the first of the conclusion slides.
Hi, thanks, Peter. So this is again, it's quite a busy slide, and I've covered some of this already, so I'm not going to go through every single point. But again, when you look at this shows, and you read through the notes, it shows those 3 growth trends that Matthew talked about in action. We are seeing a much stronger pipeline in investment advisory and kind of a recovery after a slightly weaker period than we would have liked. But again, we have seen those. We're now 4 months into this half, so we've got quite a lot of visibility for this period. In the outsourcing division, the organic growth is continuing, again led by the Irish and Luxembourg Mancos, so both having a very, very strong first half of our year, but also second half as a continuation in that theme. And data and analytics continues to grow very, very quickly. It is led by ESG, but actually, I mean, the revenue growth, a lot of it is coming through this really strong growth in ESG, but the growth is also in quantitative solutions. It is also in our performance analytics business, which has got very, very, very high margins, which is also helping to keep our margins up as we invest, particularly in that ESG business. We're expecting high single-digit organic growth as a group. And again, I suppose last 2 points to sum up, we are trading at the upper end of expectations for the full year, and we are confident of hitting the full year results through to June 2022. I'm going to hand back to Matthew with this slide now. Matthew.
Yeah, thanks, Odie. So summary, a strong 6 months to the end of December, which also provides confidence in our full year to June 22 to be at the top end of market consensus. Point 1, we've made excellent progress in transforming the revenue, EBITDA, margin in the business. So a combination of investments and acquisitions is, we're not a pure buy and build play. We grow through investing in the business and grow through small bolt-on team and software acquisitions where it makes sense. Point two, we've touched on it very heavily already with the three super trends, if I can call that, growth trends right now in our business, in the ESG in Ireland and in Luxembourg, which is partly driven by Brexit, as I mentioned earlier. Point three, our brand, we're recognised, very recognised in our industry, which is private markets. And there's a huge opportunity for us to cross-sell. 1,400 clients, but we're a fraction of their spend in all of our areas. So there's an opportunity for us to provide them more solutions. And lastly, we're only just over halfway through a 20-year plan to be everything our clients need, everywhere they need it, and at scale. So we've got a clear vision, a clear growth vision. So thanks, everybody. That's the end of our show.
Thank you, Matthew. The end of the show now, into the Q&A. So thank you very much, and thank you to Peter and Odie as well for the presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But while the company take a few moments to review those questions submitted today, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've had a number of questions submitted throughout today's presentation. Thank you very much for those investors who have submitted those. Odie, if I may, perhaps I could ask you to read out those questions where appropriate to do so, give responses, or direct it to a member of the team. That'd be fantastic.
100%. I'll do them in the order in which they came in. I think hopefully we'll have time for all of them. Given time to launch new funds, I imagine most of the recent revenue growth is from funds launched pre-Ukraine war, and which will underpin your FY22 targets. What are you seeing regarding client demand and pipeline development since that time? Matthew?
Yes, to the first question. The client will take, say, 6 months or so working internally on the idea of a new fund. They don't, because it's very long-term assets and long-term funds, they don't have to launch at a certain time. So, for example, during the first COVID lockdown, we noticed a pausing. It wasn't a cancellation, it was a pausing of a new launch. So absolutely, we're working on funds which were germinated before the European war. We're not actually, because we're very Anglo-American, we're not noticing, and we're not emerging markets. We're not noticing an effect as dramatic as the COVID effect was. So we're not noticing an effect through the war, but those questions will probably start emerging at the back end of this calendar year, but they're not coming up right now. And also, having been involved in private markets all of my career, which is longer than I care to remember, certainly it's over 30 years. I stopped counting at 30, by the way. So you do get moments where there's two big trends for us. One is AUM, assets under management, going up in private markets. And the other is regulation and all-round hassle going up in private markets. On the first trend, I've only seen it pause 4 times in 30 plus years. I saw it pausing, going backwards in terms of the pausing. 2020 COVID, first lockdown, that was totally new for everybody. Nobody really knew what to do. So there was a pause there, and then it bounced back quicker after that for us. And so you saw that sugar rush, if you like, after the first lockdown. It happened during the GFC. Interesting enough, during the GFC, everybody said private equity is dead because it's over leveraged, but because it's long term, they rode out the wall of debt, as everybody called it. So actually, all the debt got refied, and by and large, and private equity came out. Private equity comes out of crisis actually stronger. The one before that was the dot-com crisis. And time before that there was a small pause during the Russian bond crisis, if you can remember that one, in the late 90s. There's also a bit of a wobble during the 15% mad interest ERM business. But so essentially, we're not seeing, and I'm not seeing at the moment today, I'm not seeing the Ukraine war causing in our world any effect, other than maybe increased inflation and so sort of indirect consequence. But I think the time to review that will be the end of this. The question is very good, by the way. We'll see that any effect, we'll start seeing it emerging at the end of this calendar year, so well into our next financial year.
Okay, next question. Data and analytics, great organic growth. How much more opportunity do you have here? Is this repeating revenue, and could you expand on the US market opportunity? I'll start, and then Matthew, you can add if you'd like to. So so we see this as continuing growth. To Matthew's point earlier, our growth drivers as a business are regulation going up, asset management in general, in terms of assets under management going up. We see both of those things continuing in the markets that we're in. So more money going into private markets, and that's what we're seeing as a trend from institutional investors. And we are definitely seeing regulation going up, particularly as it relates to data and analytics. What's a massive driver for us is in the ESG space. So I'm going to, a lot of this is repeating revenue. A lot of it is SaaS-based and contracted revenue. So we've got in data and analytics a combination of advisory, technology-enabled advisory, and SaaS type of businesses, so subscriptions to systems. So the subscriptions are very, very, very sticky. The technology-enabled advisory is also very sticky. But it's also very, very high margin. And those are the things that are inside the division. The US market opportunity, I mean, I think in general, for us as a company, the US market is the largest market there is. I mean, it is a substantial portion of the assets under management in private markets. And we are very, very small in the US. Obviously, the majority of our offering is in Europe. We have a lot of US clients, but proportionately speaking, our makeup is not primarily US, and that is what the market is generally made up of, is primarily US managers and US funds. And so there's a big opportunity for us to grow. In ESG in particular, the US market is behind Europe, and when it catches up pretty quickly normally. And we are seeing some of the first signs of the phenomenal growth that we've seen in Europe. We're seeing some of that starting in the US now, as a result of people realizing climate change has a material consequence for them and their business, and also investor demands. And as these very, very large managers with big brands are doing, and which are global in nature, are doing these things in Europe, they're also starting to do a lot more of them in the US. Our performance analytics business in particular has got a very strong US focus, and in the big blue chip mega buyout space as well. And so we're seeing that continue. So we think, again, US market is a huge opportunity for us in data and analytics, but for the group as a whole. And I guess I'll ask
let me
Matt
just jump into, just finish that off, Odie. Yeah, in terms of the actual, also one point coming out of the question, which is roughly speaking, Peter can follow up with precise numbers, but let's say half our revenue comes from the UK, 25% from Europe and Northern Europe, and 25% from Northern America. And similarly, we get paid in these three currencies as well: sterling, dollars, and euros. But a lot of that US revenue comes from US players doing things in Europe. So we haven't got that much penetration in direct US sales. But the great thing about data and analytics, which is behind the question, I think, the great thing about data analytics is basically borderless. It's software and math, as they say in America. So we can sell it easier into the US, and we are. So some of our very best US clients, our very best US revenue comes from selling data and analytics to really big US fund managers. I wish I could give you the names, but well, we have confidentiality of our clients. But some of the biggest names you would have heard of in US private equity, we sell data. So yes, it's a big opportunity for us to grow revenue in the US fairly cheaply, if I put it that way, without much stuff, because it's once you have the data, you can provide the analysis.
Okay. Next question: Is the increase in regulatory capital the driver of the increase in debt? We've partially answered that, but maybe Peter.
Yeah. Yes. In terms of the drawdown in August, yes, it was pretty well entirely to cover that growth. The previous Santander facility drawdown that we did in the previous financial year, which we covered at the full year numbers, was all around M&A and a bit of reg cap in there as well, but that was largely for M&A. And we drew down a further 3 million on the facility in January, which was entirely to support the gearing up of people and the technology side for Ireland and ESG, where you've already heard the numbers in terms of the increase in headcount there. That needed to be funded, and so we drew down what we needed from the Santander facility for that. But yeah, the 7 million in the half year was all about reg cap.
Great, thank you. How much more team expansion do you envisage in the coming year or two? And have you found it difficult attracting talent in the current labour market, Matthew?
Yeah, I mean, as you saw from that slide about the 20-year plan, by 2030, we think we'll have over 2,000 specialists. And right now, maybe we have 300 in broad terms. So that's a big increase. Now we can add headcount by buying businesses, these bolt-on businesses, but typically they're quite understaffed. Actually, that's one of the reasons they want to be part of a bigger platform. So Holland, ESG went from 12 to over 60, as we mentioned. Yes, we do need to add skill. We're not a commodity shop. We're a highly skilled, high-end engineering, if you wish, with increased software. The software side is less people intensive, particularly as we build out our AI tools. I don't want to sound too fancy there, but we do a bit of machine learning. We have a lot of software developers. So we do need to add people. And yeah, it's a tough labour market right now. It is. I think we lose less people than others. I mean, I would say it, I'm totally prejudiced, but we have a very strong culture at our place. We're very much into training, education, into the softer things as well. We're very proud of our culture. It sounds a daft thing to say, but our London office is up for the Best Interior Design Award of an office in London, sort of like the Oscars of design, so I'm told by the designers. Not that we spent that much money on it, but we thought very carefully for the employees what they want, as opposed to what we want for them. I read something in the FT yesterday about the big four getting rid of buildings. I mean, we're actually an office company. We're into the culture, and people actually, by and large, want to come to our office because they want to interact with their teams. But yes, it is a tough labour market right now, but I think it will get a little bit easier. There's some upside for us if things turn down, the global economy goes down a bit. Maybe we can hire a bit better. But yes, we're always hiring, and it is quite a tough labour market. I think we're doing better than most.
Net debt is, this is probably for Matthew and possibly Peter as well. Net debt is up sharply. Do you have a maximum net debt to Ebitda ratio? And can you quantify what is meant by the comment in the interim results that, quote, management expects to continue to manage the metrics within growth company norms?
Yeah. So we don't have an absolute hard and fast rule. I know the market average is two times EBITDA leverage, roughly speaking. But frankly, we're not an average company. And that's really what's behind that comment. We're a growth company. Also, our debt sort of comes, as a multiple, comes down quite quickly because we're growing the EBITDA so aggressively as well. The other thing, by the way, about our earnouts, which people factor into debt, is if these companies we buy hit their earnout targets, we're all in clover. I mean, that's because they've done really well. So actually, we want to pay maximum earn out, and the targets themselves basically contribute to that through their own cash flow success. So no, we don't have a hard and fast rule on multiples. We understand stock market, what norms, but the comment in the clever words, I didn't draft them by the way, but they're way too clever for me. But the clever words in that is getting at the fact we don't, we're not quite a normal, we're not an average company in the FTSE. Most of the FTSE is big companies who've been around for over 100 years, who've got very strong cash flow, big dividends. We're a growth company, so that's really what the comment's getting at.
Okay. What's stopping you? What is the constraining factor from taking more wallet share from your biggest clients?
I think we're partly addicted to winning new clients, to be honest with you. We love winning new clients, and we feel particularly in things like those three big growth drivers that it's a bit of a land grab moment, particularly in ESG. You just have to grab the clients while you can, because once you've got them in, hopefully there's not too many clients of ours on the call, by the way, because it sounds a bit mean. But once you've got them in, hopefully you work with them for years and years and years, if you do a good job. So it's partly our own addiction for new clients, because we started with no clients, 0. And it's partly because we just instinctively, we don't like shoving stuff down people's throats if they don't need it. We're not sort of salesy people. We didn't have anybody in sales at all until quite recently. But we have built a team, business development team, whose job it is to what we call multi-sell. We debate this quite a lot. We feel at the moment we want to win new clients and try to sell them more than one product when they come through the door. But yes, there's a huge, on the plus side of that, it's a big growth opportunity for us. Just to, we're a fraction of the market spend of these clients.
Okay. There's a question asking about the rationale for the change of chairman or the switch. Do we think it's what is the main reason for that, and do we think it's important that the chairman and CEO are both in the Channel Islands?
It was the Neds came up with the idea. The three of them and non-executive directors, and they felt it would be better for two of them to swap round as I came over to Jersey, where we're a Jersey company. Personally, I thought it was barely worth an announcement. I mean, it's not, same board, same people, just two of them wanted to swap hats. So sounds a bit a sort of lame answer, I know, but that's what happened. So yeah, it's the same board, but with Odie joining, so we finally got somebody who knows what they're doing on the board.
At least you can operate slides.
Yeah, and he knows when it is time to pass the next guy on the slides. Yeah,
exactly.
Somebody younger, better looking.
Okay, I guess this is probably for you and me, since we have most of these meetings, Matthew. But what are your investors most, if at all, concerned about with regards to your business and the growth strategy?
Well, you can start answering because I didn't follow the question properly.
So what are the concerns from investors about our growth strategy? But I can still start answering.
No, I'll start. Okay, as you laid it open for me. If you're a growth company in a regulated area, you need capital. And that's, when we IPO'd, it wasn't an exit. Nobody was selling. That I bought shares on the IPO. So there was no selling going on. It was, it's a way of accessing you need to raise capital in equity and debt to grow the way we want to grow in a regulated area. There's a very high barrier to entry now. If you want to get in, do what we now do, it's quite a strong, high barrier to entry. So where does that lead us? Well, it leads us to, the need to, if we want to continue growing as aggressively as we are, to raise more capital. So that worries investors, when they're going to raise money and what price, and are they going to dilute us? Are they going to raise too much debt? Or so, I mean, I speak as the biggest shareholder as well as the CEO. I'm very, very interested in not being diluted for the wrong reason. So I think that's the point. Is how do we raise money, when we raise money, and but we feel we've got a good plan and it's under control. And the second thing which might worry investors is kind of related, which is we're a growth company, and certainly the UK stock market doesn't have too many growth companies. The third thing is probably, even though for us it's a very simple business, which we've got a platform of solutions for an industry, and that's all we do. For us, it's, but we're in this world day in, day out, whereas investors aren't. So we operate in a private market, but we're a public company. So again, that's I think we sometimes need to be coached to how to better position our company and explain it to people who are not day in, day out in our industry. How's that, Udi? Do you want to pick up the last comment?
I mean, I think yeah, you covered all the points I would have made. I think the one thing I would add, and actually I should have said the questioner said it looks sound to me, but intrigued to get the bear case. So I think it is sound. I think the market is very much in our favor, and that the point you made earlier about the overall drivers, the themes aside for a second, because obviously those themes are very, very strong drivers of the growth of the group right now. But the main drivers are growth in AUM, in alternative investments, and particularly private markets, and more regulation. And we do see those in the pockets that we're in. We see both of those things increasing, and with very little end in sight. Is it possible, if there is a severe recession, if you want to hear the bear case, if there is a severe recession and stagflation, and we have a real problem in the economy, is it possible for the overall AUM in private markets to go down or not to grow as fast? It is possible, but we still see that as a very, very low probability event, even in the case of a recession, because these assets are still quite attractive during most recessions. But we can see a potential for things not growing quite as quickly, and we saw some of that happen, during the lockdowns where everything slowed down. But all that happened was it created a pent-up demand for then revenue growth, and for the market to come back a little bit stronger.
Also, the beauty about our business is that it's long-term contracts, and even if they're not contracted for a long time, they run for a long time. So if we just stopped growing, or the market stopped, we just keep on going with our existing contracts, because these are, you can't redeem out of many of our funds. It's largely uncorrelated to public markets. But the big bad recession is big bad for everybody. But I think we're actually quite a good bear story in such a case.
Yeah, and I guess the only other thing I would add to Matthew's point earlier on the to expand on it is the growth versus profits, and what do we prioritize. And so there are some investors who want to see the business be very, very profitable, at an EPS level, and our focus, as we've said for the last few years, has been primarily on growing. There's a massive opportunity to grow a relatively small company into something very substantial, and that is our core priority. And obviously we're trying to do that in a responsible way and maintain ongoing profits, but that is the one thing we do hear from investors on occasion. So I guess maybe on that note, I can see we've come up to 6 o'clock, so maybe Matthew, any final points before we sign off?
Yeah, I mean, just to summarize it in a minute. We're a picks and shovels play, and with increasing data and analytical software-driven tools to the long-term private markets. Our funds are very long-term, as we mentioned. They're broadly speaking uncorrelated to listed equity and bond markets, and they're driven by two major long-term tailwinds. One is assets under management or allocation to private markets going up. And that question earlier, by the way, even if one of those assets classes is less popular, like venture capital, real estate may come up to balance out, but the growth is there in AUM. And the second big driver is regulation and change and all around hassle. We're a British-founded growth company with a 20-year plan. We're 11 years in, and that plan is to be the leading global solutions provider to the private markets industry. And we're very confident about our future direction and growth.
That's fantastic. Thank you very much indeed, Matthew, and thank you both to Odie and Peter as well. Ladies and gentlemen, do please continue to submit any further questions you have. The team will be able to review these, of course, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Before I close the session, you will be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of MJ Hudson Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.
Right.